Hello, and welcome to the 8th episode of the Market Pulse series. My name is Rufas Kamau, Market Analyst at FX Pesa. So, feel welcome to the session. You should know that this session normally airs at 8 p.m., but somehow, due to unavoidable circumstances, we had to do these earlier, and we are doing this at 2:15 p.m. So, hopefully, if you're joining later, you should understand this. So, now that we passed that, I'd like to do a mic test. So if you can hear me clearly, kindly type hi on the live comment section, and this will confirm that everything is working just fine. Awesome. So in today's presentation, we're going to cover quite a number of topics. They are very, very simple, but also very instrumental to any forex trader, indices, and commodities trader. So we'll be focusing on trading fundamental news, and this is with a key reference to forex. So when we talk about fundamental news, we're basically talking about factors that influence the movement of a currency. And we all know that currencies are issued by central banks. So central banks are the major players or influencers of the movement of currencies across the world. So we look at effects of monetary policy decisions on currency exchange rates. We look at leading as well as lagging fundamental indicators. We look at the mandates or what the central banks focus on, and also how to trade the monetary policy divergences. So once we cover these, hopefully it will be useful and help you transition through the journey in your trading. So hello, Kyoko, hello, Joseph, hello, Paul, Apollo, Helia, thank you guys, thank you for joining the session. Let's get on with this. All right, so when it comes to central banks, we know that they have the responsibility of supplying currency within an economy. So among the major central banks that we focus on in forex trading are the central banks of the major economies where the currencies are deemed to be more stable and also more liquid. So when you compare the global trade, of course, the US dollar dominates as the world reserve currency. The Chinese currency is prone to manipulation as the economy return depends on their currency to support trade. Remember, China is a major manufacturer in the world and exports its product to virtually the rest of the world. So it's not very popular among forex traders, but then we majorly focus on the euro, which is a currency that is shared by quite a large number of countries. So there's a lot of volume that happens between the euro and the US dollar. So we also focus on the pound, or basically the European financial capital. So the pound tends to be very instrumental, and it becomes easy to trade since it's based on an open market. Then also there's the Canadian dollar, the Swiss franc, the Japanese yen, the Australian dollar, and the New Zealand dollar. So each of these currencies is issued by a particular central bank. So for the US, it's the Federal Reserve Bank of the US or the Fed. The Eurozone is the ECB or the European Central Bank. For Switzerland is SNB or the Swiss National Bank. For Canada is Bank of Canada or BOC. We have BOE or the Bank of England issuing the pound. We have the Reserve Bank of Australia, Reserve Bank of New Zealand, and also the Bank of Japan. So when you study these central banks, you realize that they have one mandate in common. So all these central banks have quite a number of mandates that mirror each other. And one, they have the responsibility of making sure that there is sufficient supply of currency within the economy. They have a mandate to make sure that there is stable prices. So that's a big job for every other central bank. They also have a mandate to make sure that the economy is growing. So economic growth is also a mandate with the central banks. And also they have a mandate to ensure full employment within an economy. So in order to achieve these mandates, they have a set of monetary policy tools that they use to manipulate the economy in the direction that they intend to get to. So some of these policy tools include one, they basically change interest rates within an economy, and we know the interest rates and the effect they have in an economy. So if interest rates are generally higher, It basically means that the cost of acquiring loans is higher. So people get less loans from financial institutions. And this basically ensures that there is a less supply of money. And this has the effect of slowing down the economy. But at the same time, it has the effect of controlling inflation. So it makes money worth more when interest rates are higher. On the other hand, when interest rates are cut down or they are going down lower, we experience an environment where it's easy to acquire capital at low rates. So we normally get an excess supply of currency within an economy, which basically raises prices or basically causes inflation. So that's one of the tools that central banks normally use to basically influence the direction the economy is taking. So we also have what we call quantitative easing, and this is basically pumping more money into the economy. Can be done on several fronts. Banks can sometimes outright print more currency and pump this currency into the economy through financial institutions. So the way they do this is pretty simple. They basically print more money and then buy risk assets in the markets. Some of them could be mortgage-backed securities, it could be corporate bonds, or basically the treasury bonds. So when they buy these bonds, they basically get the certificates and the money flows into the economy, and these can stimulate an economy to grow faster. At the same time, it causes inflation. So quantitative easing is a common policy that central banks may use, especially in times of a crisis. And the opposite of this, which is quantitative tightening, which is basically removing all this easing into the economy, withdrawing liquidity, which basically dries up capital and slows down the economy. So among other tools that it uses is changes in reserve requirements. So remember, when commercial banks are collecting cash in form of deposits from their clients, they are supposed to have a particular set of reserve with the central bank. So if this ratio is adjusted by the central bank, it could release more funds into the commercial banks or draw more funds away from the commercial banks. So depending on the direction of the reserve ratio, it may induce commercial banks to issue more loans because they have excess cash, or it may induce them to issue less loans because they have less cash. So those are some of the tools that commercial banks will normally use in influencing policy within an economy. At the same time, we know that they also issue what we call corporate bonds, can be treasury bills, can be treasury notes. So they basically borrow from the economy, thereby reducing money in the economy. And also once these bonds mature, then they pump this money back into the economy. So all those are monetary tools that central banks may use to implement their mandates. And that is, as mentioned, ensuring economic growth, ensuring full employment, at the same time ensuring stable prices. So now that we understand that part regarding central banks, there's also data points that they may consider in order to tell whether the economy is basically getting the desired effect once they implement their policies. So for instance, in order to make sure that they are achieving economic growth, they will normally track economic growth data to see how the economy is performing. So one of the most important figures for them is the GDP, or the gross domestic product in an economy, in order to tell how strongly the economy is growing. So for most economies, they don't literally grow universally. They have key contributors that drive the direction of the economy. For instance, if you are in China, the economy is majorly driven by manufacturing. So if manufacturing is slowing down in China, then it's bound to have an overall effect on the overall GDP. So as a leading indicator of GDP or economic growth, the Chinese central bank will majorly focus on the trends in manufacturing. They will do a lot of surveys and data collection to understand the conditions in the manufacturing sector, and then use these data to make decisions about monetary policy. So in Kenya, majorly it's agriculture. So if agriculture is doing well, then overall we expect that the Kenyan GDP will be doing well. So different economies have different economic drivers. So for instance, if you look at the UK, it's majorly, we focus on the services sector. Financial services is a key contributor to their GDP. So we also look at Germany. You realize that manufacturing is big in Germany. If you look at Canada, oil exports is a key contributor. If it's New Zealand, it's mainly agriculture with key focus on dairy products. If it's Japan, yes, we have manufacturing, but if you narrow down further, then there's manufacturing and export of cars as well as other machinery. So by focusing on that smaller data set, then you're able to predict or speculate the direction of the economy or the economic growth as a leading indicator, one sector being a key contributor. If you follow the trends in that sector, then you can get a leading indicator on where the GDP is headed. So the other key data that central banks focus on is jobs data. They want to know the unemployment rate within the economy. They want to know the number of new job openings and wage growth. And once they understand these, then they are able to weigh whether they are closer or further from achieving their targets. So they take this data into consideration before making decisions. Now that we understand the two data points, economic growth and jobs data, when it comes to inflation, and they want to know whether prices are stable in the economy or not, they basically focus on a data point called consumer price index. So this is basically a basket of commodities that are used by the average household in an economy. And this basket will have several features that we normally use in your everyday life. So first, they look at our food and beverages. That's big. You know that every single household in the entire country consumes food. So if you weigh the cost of food over different periods, you can tell whether food is getting expensive or cheaper. Then they also look at energy prices. You need lighting, you need travel and all that. So they will basically track the energy bills to see whether they are getting higher or lower. Then there is housing. Housing always has a cost. So they track the average price of housing for the average household within an economy. They also look at healthcare. Everyone needs healthcare. They look at the cost of healthcare within an economy. They look at clothing. Everyone needs clothing. Every household spends at least some money on clothing and so on. So they also look at alcoholic drinks, beverages, and all that. So once you take this fixed basket and then compare it over different periods of time, then you can tell whether prices are stable or whether they are very unstable. So if prices are generally increasing, we say there is a high inflation. If they're generally decreasing, we say there's a deflation, which is a opposite of inflation. So central banks will track these data points and combine them in a way that they use them to make decisions. So for most central banks in the world, they don't make decisions on monetary policy. They only implement. So when it comes to making decisions about an economy, a special board is basically appointed within that economy to literally have experts and representatives. And this board will basically sit almost universally in most economies. It's every month. So the board members will sit down every month, discuss these data points, answer several questions regarding the economy, and then vote on a decision. So these boards are basically described as monetary policy committees. So a monetary policy committee will have several appointees. In Kenya, they are supposed to be, I think, 10. Different economies will have different numbers for their monetary policy committees. And also sometimes you might find that the monetary policy committee has a different name. So in the UK, it's MPC, Monetary Policy Committee. If you go to the US, it's the Federal Open Market Committee on the FOMC. So once they make those decisions, then the central bank is left with the role of implementing those decisions. So now that you understand that key concept, it's time now to focus on the charts. So as we proceed, if you have any questions arising from the presentation, feel free to type those questions in the live comment section, and I'll be responding to those questions as we proceed. So, hello Gerard, hello Anne, hello Paul, hello Annette. Thank you guys, thank you for joining. Would be interested in views on market sentiments, US dollar, do we expect the downward trend to continue? Good questions, keep them coming. I'll be responding as we approach the end of the presentation. So, that being mentioned, we move on to the next part of today's presentation. And now we focus on this particular chart. And this is the exchange rate between the euro and the US dollar. So clearly, you can see that this has been on a bearish momentum for quite a lengthy duration of time. So what has been happening here is that we saw a very strong policy divergence between the European Central Bank and the Federal Reserve of the US. So since around October, this is when we started seeing the major shifts in policy. On one hand, the US was basically practicing quantitative easing. This was towards the end of COVID-19. So a lot of money was being printed in the US, and this was highly inflationary. So if you look at the exchange rate of the Euro USD, during the COVID year, the Euro was basically gaining against the dollar. The main reason this was happening was because the quantitative easing program was more aggressive in the US compared to the Eurozone. That is, the US was printing money at a much faster rate compared to the Eurozone. So with this in mind, we know that if they're printing more money, they are increasing supply. You remember when they were giving the 1,400 stimulus checks to the people who are suffering from unemployment during the COVID-19 situation. So a lot of money was flowing in the US economy, and the US dollar was losing, while US equities were rising. So if you are to check the S&P 500 and how it was performing during the pandemic, you notice that the stocks were really strong. So just to give you a hint, this was the area around March to December. So at the beginning, there was a panic and collapse due to COVID, and then the market recovered strongly and kept going up. So all the way up towards the end of the year, the S&P 500, or basically a representation of US equities, they were gradually going up. So after the crash, a very sharp V-shaped recovery, and the market kept going up. So that's literally what was happening during the COVID period. So as we approached 2021, there was a tech from the Federal Reserve policymakers, basically saying that they are now looking to reduce these in order to prepare for hiking interest rates. So during this period, they had lowered interest rates to 0.1 to 0.25%, and inflation was pretty low. So in this case, they were just pumping more money into the economy to support the struggling firms. So now, when you focus on this period, when money started drying out, they started cutting on the quantitative easing, then the dollar started strengthening against the euro. So remember, the Eurozone was also doing the same, but there was a policy divergence, meaning that they were not doing it at the same rate. So from here, the euro started gaining some strength against the dollar. The dollar gained some strength against the euro. So there was a out of back and forth, euro losing, euro gaining, euro losing. So majorly in 2021, we can say that the market was moving sideways. So all the way towards the end of 2021, this was the movement. Clearly, the euro was basically losing to the dollar. And once we got to 2022, here is where we saw the major shift. So from here, it was very clear that the US is ending the quantitative easing program. The Eurozone had not ended its quantitative easing program. So on one hand, one central bank was printing more money to support its economy. The other one had ended the printing program and was preparing to hike interest rates, which would drive the dollar out of circulation. So it would make the dollar so strong that we enjoyed a very strong bearish momentum for the rest of the year. So here it was clear the dollar was just losing against the euro, though there is a swings in between. The overall trend was bearish, and we saw this happen all the way up to the end of last month. So this month, we can already see that the euro is now picking up and strongly moving against the dollar. So we know that from recent speeches by the central bank members, that is the FOMC members, as well as the Fed Reserve Chair, Jerome Powell, they are now looking to slow down the rate hikes in order to prepare for a potential rate cut in mid-2023. So as for now, policy is indicating that the Federal Reserve Bank of the US will be slowing interest rate hikes. So if they do, let's say, a 50 basis point hike in December, then January is expected to be even slower. So with that in mind, when you look at the ECB, from the most recent data, that is inflation data on Wednesday, it indicated that the Eurozone is suffering from 10% inflation. So the inflation rate in the US is 7.7%, having topped at 9.1%. So with the very high inflation in the Eurozone, the ECB is bound to obey its mandate of maintaining stable prices. So it might do a very strong rate hike of potentially 75 basis points or even 100 basis points. So with this in mind, you can now see the policy divergence. One is accelerating interest rate hikes. The other one is slowing interest rate hikes. So the one that is accelerating interest rate hikes is driving euros out of circulation. In this case, we expect a strong euro, whereas the dollar will start weakening. And here you can see the change in price here, or the exchange rate between the euro and the US dollar, is already happening way before that has been implemented. So investors will always try to front run these policymakers. So whenever there's speeches, comments, press conferences by these central banks, investors are following closely so that they can enter their positions early before the announcement actually happens. So for instance, if you look at interest rates this year, the US started hiking interest rates in March. And this was March right here. This is March. But if you notice clearly, the bearish momentum had started a couple of months earlier. So investors knew that the US would be looking to hike interest rates. So they basically started shorting the Euro USD earlier, right? Let's say from January. And then February, they kept shorting March. And then they kept on going downwards. So with that in mind, now it makes a lot of sense to follow the central bank policies and also track the data that the central banks are following. So when you track this data, then you can easily establish in an economy where there is a policy divergence, and you can speculate the overall trend in a particular currency pair. For instance, let's look at USD JPY. So this is the US dollar traded against the Japanese yen. So clearly, there has been a very strong policy divergence since the beginning of the year. So if you look at the opening price in January, it's somewhere around here. This is around 114. And the highest exchange rate we have seen here is right here. And this is around 151. So this is a very major shift in the exchange rate between two major currencies. So from here all the way up to here, it's a shift of 32%. And 32% is a big shift, especially for two major economies, that is the US and Japan. So during this period, we know that the US was hiking interest rates throughout the year, that is throughout 2022, whereas the Bank of Japan was just stimulating its economy. Interest rates are currently at negative 0.1%, whereas the US has moved interest rates from 0.25 to literally 4%. So during this period, the divergence has caused this momentum in the currency pair. So knowing this divergence and using it to your advantage, as a forex trader, you might not be able to hold a position for an entire year or even for 6 months to benefit from all these movements. However, since you're trading in probabilities and you know that there's a high chance that this divergence in policy will keep pushing prices higher, then you identify a buyers in such a market. So in this case, the buyers was bullish. So if literally every single day that you traded on USD JPY, you went for a bullish position, then you'd have more winning trades than losing trades, especially judging from these kind of things. There's only a very small number of days where the USD was losing against the Japanese yen over the year. Majority of the candlesticks were going up, implying that the dollar was gaining against the Japanese yen. So once you've done all these analyses, it's all about using your technical analysis skills to look for the right opportunities in the market along the direction of the policy divergence. So since we hit this top at 151, you can already see that investors are taking profit. Prices are moving back down, currently around 135.5. And perhaps if the policy divergence continues, then you'll see the Japanese yen now strengthening further against the US dollar. So in this case, as we head into 2023, a key focus will be on the Bank of Japan, the policies it's looking to implement in the new year, whether they will be looking to raise interest rates, whether they will be looking to reduce quantitative easing, in comparison with the Federal Reserve of the US, which has already stated that it's slowing down interest rates hikes in preparation for potentially some rate cuts in 2023. So investors are already pricing in this, and you can see how the market has dropped from this high of 151 down to 135. So that's one key thing to consider, especially when you are trading these fundamentals. So this marks almost the end of the presentation. So let's check a couple of questions that you have and try to answer them right away. So views on markets sentiments, US dollar, do we expect downward trend to continue? These are good question. So do we expect the downward trend to continue? I'm assuming that the downward trend is what we experienced yesterday after the speech. So yesterday after the speech by Jerome Powell, which is who is the Fed chair, you can see that the pound was very strong, moving against the dollar, and today went up, pulled back in the London Open, and then continued going up. So this is basically pricing in a policy divergence, where in this case, the Bank of England will be looking to hike interest rates further in order to control the rising inflation in the economy, and the US is now slowing down on the rate hikes. So if one central bank is more aggressive than the other, then there's a divergence, and this basically creates a dilation in the market. So it will be tougher to get pounds than dollars. So in this case, we are basically seeing a bullish momentum. So remember, this was multi-year highs, and they represent very good entry opportunities in the market. So the pound was also losing for the better part of the year against the dollar, bottomed at around 1.034. And now you can see the strong reversal, and also it's breaking major trend lines here. So these are trend line on the daily that was recently broken, and since then the market has continually been pushing higher. So if the Bank of England keeps hiking interest rates and the US is slowing down, then the direction is potentially moving higher. However, if the Fed was to get stronger in terms of raising interest rates, then we should be looking at prices moving back down. So investors will be processing the different data points that emerge from the daily reports that we normally get from the economic calendar. So for instance, if let's say on the next reading, UK inflation jumps higher, let's say it gets to 11%, then the Bank of England will be forced to make a very strong interest rate hike. So this strong interest rate hike is synonymous to quantitative tightening, and it basically removes pounds out of circulation and makes the pound much stronger than other currencies. So this would basically make the pound more bullish against the dollar. So that's basically how we interpret these news in the markets and use them to our advantage. So whenever you realize that there is a strong policy divergence between two economies, then you basically take advantage of that divergence and use it as a bias in your trading. So once you establish the right bias, then the rest remains as looking for technical entry opportunities in the markets where you are moving in the direction of the bias. So same case with the Euro USD. You can see yesterday, very strong momentum in the beginning, and a further momentum before pulling back at the London Open, and then an attempt to move even higher. So at some point, we expect that the dollar is still strong. Doesn't mean that the Fed has completely abandoned the rate hikes. They are just slowing down. So if an economy is unable to catch up with the rate hikes, then it will be the losing side against the dollar. So if you look at a very quick overview of the economic calendar, we try and get this. Sorry, here is the economic calendar. I just want to give you a brief highlight of the interest rates situation right now. So right now, the most aggressive central bank is the New Zealand, or the Reserve Bank of New Zealand, which has hiked rates to 4.25%. So US Fed 4%, Bank of Canada 3.75%, Bank of England 3%, Bank of Australia 2.85%, the ECB 2%, the SNB 0.5%, whereas the BOJ is at negative 0.1%. So clearly, the Japanese economy is still suffering from high quantitative easing as well as low interest rates. So it's supposed to be bullish for their equities. So if you are trading in a Japanese equities, you should probably be looking for bullish positions. But at the same time, it's very bad for their currency. So yes, their currency has been losing, and in recent times it has been regaining ground against other currencies. But overall, there is still a very strong divergence between Japanese yen and other currencies. So if I was to find a very aggressive currency pair, let's say New Zealand, and trade it against the Japanese yen, then I would be expecting the New Zealand dollar to be strengthening against the yen. So let's check these out. So we check, I think this is New Zealand JPY. So let's do this. So you can see that there has been a lot of swings in the same, but overall, for the better part of the year, it's quite clear that the trend is upwards, meaning that the New Zealand dollar has generally been gaining against the Japanese yen. So the main reason for this is the policy divergence between the two economies. So now that you have a bias, and it's clear that if you have more buying positions than short selling position, you get to benefit from the policy divergence as you have a higher winning probability. Then it basically means you look for bullish positions whenever the market pulls back down. So if you are trading these, then you know every time the market pulls back down, this is the right moment to look for bullish positions. So that's basically how you build a narrative into a currency trading pair, and then look for the right opportunities to make a market entry. So for instance, if I was trading these and somehow, I'm not saying it will happen, or let's say the market pulls back down, gets to a lower trend line, then I'll be looking for signs of bullish entry so that I can buy and target even higher prices. So this is built on the understanding of the policy divergence between the two central banks, which basically determine the currency direction. So once you understand that, then you basically improve your chances and you have better chances of winning or basically being profitable in the markets. So checking on the next question. So what are your views on the euro? So CPI came in at 10%. So I'm expecting the ECB to implement a 75 basis point rate hike. So if it does this, then this is bound to strengthen the euro. So the challenge is now finding the alternative currency to pair it with the euro. So you might find a currency that is still very slow in implementing rate hikes, and then pair that with the euro. That should give you the alpha you need to find the right opportunities trading the euro. So how the USD affects gold? Clearly, when you're trading gold, it's in form of US dollars. So for instance, let's see this. So if you're trading gold, it's valued in dollars. So yes, the MT5 doesn't indicate, but we all know that gold is valued in dollars. I just want to find the right chart here. So this is gold clearly at this level at 1783 as a result of the weakness in the dollar. So if you look at the Jerome Powell's speech yesterday, that was late in the evening, you can see that gold strengthened against the dollar since the dollar was weakening. So in this case, we can say that the dollar has an influence on the dollar, on gold, or gold has an influence on the dollar. It's only that one is valued using the other. So the dollar is valued using gold, and gold is valued using the dollar. So in this case, when we look at this chart and try to interpret what's happening, clearly it's a market that has been bearish for the better part of the year. So since hitting this particular high way back in March, then you can see it was a bearish momentum, a very strong one for that matter, before the market broke towards the upper side. So after breaking out, you can see the strong momentum, pulled back down for a while, and now seems to be pushing even higher. So this is a major resistance level. That is the current price level in gold, around 1783. So if we manage to break the high that we saw 2 weeks ago, then there's a good chance that we'll be seeing gold flying higher. However, if this resistance holds, then we'll be expecting gold to push back down. So if we follow the direction of the Fed and the dollar continues strengthening towards the December meeting, then we should be able to see gold moving back down. On the other hand, if the dollar keeps weakening, then gold breaks this resistance and keeps going up. So we just have to identify it as a pair. So even if you're trading gold, you're also trading a pair. On one side, you have an asset called gold, and on the other hand, you have an asset called the US dollar. So still checking on the questions as we approach the end of the presentation. Hopefully, you realize some value from the presentation. So Jerome Powell's speech yesterday was taken by the market dovish, even though it wasn't. Do you think the gold can correct the move it made yesterday? Yes, it's a real possibility. I'm actually banking on that, but I'm still waiting on price action to show me indications of bearish momentum. So US30 and Nasdaq, with the mojo injected yesterday, sustained. US30 appeared to be on a long-term sell. Yes, my overall analysis is that I will be seeing some long-term bearish momentum in the Dow Jones index. So just trying to get the right chart. So this is the daily chart. So since the beginning of the year, we started here. We managed to hit the high again, and a third time here, and also the fourth time we broke here. So remember, for any trend line that you are watching, the more the points that have hit that trend line, the higher the chance that the market will eventually break that trend line in future. So in this case, eventually the trend line was broken. Market tested this area. I found resistance. It was a very nice entry. I remember sharing this. So looking for short selling momentum from here. Market did not last on the lower side for long before breaking all the way up. However, if you look at yesterday's momentum, this was about 3.6%. So this is it. Sorry, 2.79. 3.6 was in the S&P 500. So 2.8%. But since then, if you look at the smaller time frame, 15 minutes chart, you can see from yesterday's high, the market has been largely quiet, moving sideways. So there's no enough momentum to sustain this particular move that we saw yesterday. So there's a good chance that we'll be seeing this movement reverse back down to the lower side. So I don't see any reason why the market should be rallying. There's no cause for this, even though we'll be looking at the potential Santa rally, that is the 5 days after Christmas towards New Year. We may be expecting some Santa rally to happen in S&P 500, the Dow, and also the Nasdaq. But as for now, my overall thesis is that we will be seeing prices move back down. So nothing has changed fundamentally. Yes, the Fed is slowing down the rate hikes, but inflation is still significantly high at 7.7%. Consumer budgets are still suppressed. At the same time, interest rates are also very high. So the cost of acquiring capital is still getting high from 4% going to 4.5%. It's not a joke compared that at the beginning of the year, it was 0.25%. So housing market is still cooling off. I don't see any way that we'll be having a sustained bull market. So eventually this bull market will end and we'll see another movement back down. So it's just a matter of waiting for the right market entry and also doing your technical analysis to find the right entries. So thank you very much, guys. Thank you for your time. And also thank you for your participation in this particular session. I always appreciate you guys. I hope to see you on the next session. So remember, on Saturday, we'll be having the last grand finale financial literacy session. This will be at Nairobi Garage, Pine Tree Plaza. So if you're available, make sure that you book your space and we meet over there, discuss what has happened over the year, what you're expecting for next year, any new products or changes that we have in our company. We'll be sharing more information. And at the same time, get to hang out with other traders, share experiences, and basically get to enjoy the end of the year. So thank you very much, guys. See you on the next session.